Well, g'day there, traders and friends, market enthusiasts right around the world. You are here with James on behalf of Pivot Point Trading as I sit down on this Thursday evening and bring you a snapshot of the technical picture, given, of course, the pullback which we have seen really continue into and throughout Thursday's trading session. The Dow Jones Industrial Average closed down just over 200 points on the daily candlestick. It is very similar or a hybrid between an engulfing candlestick pattern and also a one black crow candlestick right up at this resistance level, a very important resistance level. The S&P 500 closed down very close to 20 points, 19.34. Another interesting candlestick indicating that we are going to see further weakness. And most importantly to point out over the past 2 weeks is that we've now established more or less a lower high on a very molecular level. You can see on the S&P 500, the pullback which we saw to begin this week's current worth of trading was to come back into the 10 exponential moving average. A lot of people getting excited about the bounce continuation as we have seen at the beginning of April. Well, as you can see, it really starts, or at least it seems to be really fizzling out, and we're starting to see again sellers move back into the market. The same is true on the Dow Jones Industrial Average, although I just recapped the individual candlestick and the daily point decline. On the NASDAQ, what's most important to note is that we did close down very close to 60 points on Thursday, 57.85 in the top right hand corner of my chart right here. However, the big difference between the NASDAQ and the Dow and the S&P is that the NASDAQ itself didn't see a little bullish pop to establish that secondary little lower high. Instead, it's just completely reversed as at the gap over here, which is really indicating once again that island reversal which we spoke about over the weekend. Very interesting advancements. The NASDAQ is flirting with the molecular short-term lower low which we've established in April. Or at the beginning of April, where we sort of hit it for about 2 weeks and we saw that sort of exhaustion pop to the upside back into this open rectangular box, which is really where the gap fill started the year 2016. We are still negative year to date on the NASDAQ, and for a long time I've been speaking about how this open gap once again has been acting as a magnet. Well, obviously we haven't closed it. We came very close to closing it over the past 2 weeks when we saw, a plethora of spinning top candlesticks. We got back up into the gap. However, we actually didn't see the NASDAQ move all the way back up to 5,000. So long term, or at least more so intermediate term, I am expecting the NASDAQ to ultimately come back up and fill this gap. However, as it stands as at the close on Thursday, the markets are looking exceptionally weak. I'm going to speak about this in more detail. But before I do, let me just recap some of our top 12 individual shares. A lot of, or at least a couple of companies have reported earnings. Last week was the major week where the majority of our companies which we follow reported earnings. But most noticeably this week, Apple. Okay, Apple got absolutely belted. If you have a look at its price movement, I mean, you're seeing the same types of candlesticks and also chart patterns set up. You see that little island reversal setting up on Apple. A pretty worrisome signal given that, of course, we are still setting up consecutive lower highs. If I zoom out to the year, really beginning 2015, we peaked out over here with 3 relative highs. But since then, I mean, we're feeling the definition of a downward trend, and really the earnings gap which we've seen established itself this week, it really contributes to the continuation of this bearish move. You can see the relative lower high setting up, and it looks as though Apple is on its way to close down here at 93.46, but ultimately take out the lows which we saw to begin 2016 in January, in February. My biggest contention with Apple at the moment is that obviously we have a massive gap. I mean, much like the markets themselves on the NASDAQ where I've been speaking that, look, these gaps should, and to a high probability fill, I expect the same on Apple. So what I'm really expecting right now, the reason why I didn't put out a video yesterday was because the risk and reward on a continuation gap trade, it just simply wasn't there because we more or less gapped back down into macro support. Now that we are here, this is what I'm expecting for Apple to do, and it really coincides nicely with my overall NASDAQ look, expecting it once again to come back up to fill this gap, and that will be the end of the exhaustion, or at least the exhaustion of this most bullish counter trend wave which we've seen establish itself since February 2016. But going back to Apple, I expect it to sort of fizzle out down here about $92, $93 a share, but then to ultimately start its slope of hope reversal back up into fill the gap, which is going to act as resistance and a really great opportunity to take on some advantageous shorts up at around the 105 area. A very interesting stock, or at least somewhat of a comparison to take note of in terms of the Apple trade is the most recent earnings report on IBM. If I quickly change to IBM, you can see it's gapped gap down after its earnings. Now, what I was speaking about over the weekend was how there's a very high probability, once again, that we come back up, try and fill the gap. And if that does take place, to look for reversal candlesticks to sort of set yourself up into new shorts. And as you can see, IBM climbed from about 143 all the way back up to about 150, and today we've seen once again that one black crow candlestick pattern show up at resistance. So it looks as though IBM is in the process or has more or less completed the process of the gap fill, and it's starting to set up its continuation to the downside. Apple has been tremendously weak. If I go to Google as well, Google's interesting. It hit our target, although I sat out of this individual trade below 729. The reason why is because I'm waiting for market confirmation before I start entering into a lot of longer term, or at least some aggressive shorts at the moment, given of course the volatility which we are currently seeing across all three of the US markets. Well, today, for those people who took that trade at 729, we've actually hit our target down here at 705.90. We actually closed at 705.06. So we did hit that target, but again, in full disclosure, I sat out the Google trade. The risk myself, or the risk undertaken to actually get those rewards, was just too great for me. So I find myself once again just looking at this market, almost being a passenger and letting other people really decide which direction it wants to move, right? I mean, this is a critical pivot point for the market itself. A lot of the technicals suggest that once again, we're going to see the roll at this location. The S&P again is really a very interesting market. The same with the NASDAQ, also the Dow. They're all very relevant. The Dow seems to have broken out above its primary declining bearish trend line, but when we start looking at some of the finer details, I mean, the candlesticks really aren't suggesting great continuation of the most recent bullish move. If you have a look at these, we've got the one black crow over here. We've got a plethora of spinning top candlesticks. We've got a hangman at resistance, a high wave spinning top, and then again on Friday, we've got that one black crow. The secondary lower high in a molecular level, looks like we have a little neckline establishing itself around 17,700. Sorry, not 17,700, more so 17,775. If we crack this level, we're at least coming down to about 17,550. But what you should be paying more attention to is potentially this larger pattern right here. It looks as though we're establishing a short-term left shoulder. This may be the head over here. So if I just label this H, and a left shoulder here, it wouldn't surprise me to see the structure of this market move as follows. And this is really for all three of the US market indices. Let me just color coordinate this for you. If we see the Dow come down to about 17.4, and then we establish a little bullish exhaustion move, you'd be looking for it to fail again at about 17.8, somewhere where we have roughly closed as at on Thursday. That would really give us the structure of a short-term head and shoulders chart topping pattern, but that will also correlate very nicely with the longer-term picture of these markets. We've got really a stagnant market which has been moving sideways since late 2014. If I just draw on some lines here, more or less looks as though we're moving sideways between support and resistance, but outside of the Dow Jones Industrial Average, we are establishing macro lower highs and macro lower lows, something that I've harped on about continuously for quite some time, and it's really the reason why I'm so cautious about this market moving higher, and whether or not this is a legitimate bullish move. I'm under the assumption that this is still a fake move, a bluff in many respects, and that a lot of the buyers over and during this move are going to be called out, much like they were towards the months of September and October 2015, before we see the market once again set up that lower high and roll on over, right up and through until we establish these short-term macro lower lows in January and February. So something to think about on the Dow Jones Industrial Average. It has been holding up relatively better than what the S&P and the NASDAQ has. But if you pay attention to, again, these divergences, it's something which I've been speaking about for a long time. You can see these three consecutive higher highs in price. But if you pay attention to the actual oscillators, look at the divergence on the stochastics, have a look at the RSI, they're all sloping negative. And on top of that, we've got the MACD on the daily, give us a sell signal. So all three of these oscillating indicators are telling us that the market once again is overextended, it's overbought, it's really overrun its upside potential, and that we're looking for some form of a pullback. That pullback at this point in time is again is quite contentious. I understand that, but again, I'm looking for potentially a 1, 2, 3 reversal. So we will set up a lower high relative, obviously, to where we were in February. That will get the bulls excited, but ultimately will fail, probably back up at these levels we're currently trading at, and that's going to coincide once again with the NASDAQ finally filling its gap up here at about 5,000. Again, that's going to set up very similar in terms of the chart pattern for the NASDAQ. The NASDAQ has got somewhat of the same picture of the Dow Jones Industrial Average. We've got this little left shoulder over there. We have a head potentially here. And right now we're sort of, basing ourselves at the neckline, it'll be interesting to see whether the NASDAQ cracks it below 4,801 or whether we just see the bounce immediately back up. We also have this gap fill over here, a smaller gap from this little island reversal, coinciding again very nicely with this macro right shoulder. But again, I can see the NASDAQ ultimately coming back up here. It's whether or not we break the current levels, come down to about 4.5, and then see an extended move back up to about 5,000, which is ultimately going to fail. So just think about that in terms of the short and intermediate sort of outlook, or at least projection for these markets. But pay attention once again to these divergent signals. See these higher highs in price, and you see these relative highs across the oscillators, if not lower highs across the RSI, and that definitive signal on the MACD. Well, that doesn't really bode well for the bulls, right? So these three oscillators once again are in market confirmation. We're seeing the pullback, or at least the start of the pullback. It just depends on how severe does it become, and ultimately do we come back up and refill the NASDAQ opening gap for the year 2016. Pay attention to the S&P 500. Once again, it set up a short-term lower high. You see this, I may have to zoom on in. Actually, I'll remove the current template and zoom in for you. You can see once again we have that evening star reversal up here. We've had a little pullback, tried to gap and continue, or at least continue this little bullish advancement. It's failed as at the close on Thursday. You can see again this continuation sort of bearish candlestick to the downside. What's most important to note is that it appears as though we're snapping this series of micro higher highs and higher lows at this point. If I change the oscillators, pay attention to this. We've got the sell signal on the MACD. RSI is showing us divergence, so is the stochastics. And when I bring up the exponential moving averages, a lot of people get excited about these exponential moving averages because they see this crossover here. Say, for instance, at the beginning of March, and they say, look, we're in a bullish trend, right? They see the cross, and unfortunately, they're just a little bit misinformed, right? They're probably sincere, but unfortunately, just sincerely wrong. When you see these crosses, you want to ask yourself the question, is the market or an individual stock or ETF actually trending? And when you zoom out and look at this chart, even on the daily time frame, it clearly isn't trending. We're stagnating. We're moving sideways. We set up macro, again, support down here on the S&P 500 between 1,850 and really 1,900. But at best, this market is moving sideways. It is, in fact, still setting up macro lower highs, even during this most recent run up to 2,100. So that's something really interesting to point out. But unfortunately, going back into the discussion is that they detail, or at least define, this crossover here. And they get really excited about the long-term continuation of this trend. Unfortunately, this is a defunct signal. It is an illegitimate signal. It is a deceitful signal. So what you want to look for in this case is that oftentimes, again, price will simply snap back below the 10. It'll snap back below the 20. It may sort of stop the pullback at the 50, get another temporary bounce. But ultimately, these exponential moving averages are not what you should be paying attention to, because as you can see, time after time during a sideways market movement, if you're buying the bullish crosses, well then, a month or two later, you should find yourself selling on the actual bearish cross of the exponential moving average, or at least the alignment of the 10 below the 20 and the 20 below the 50. So they are producing a lot of whipsaw signals. Again, on the Dow Jones, you can see it's cracked the 10. It's closed more or less at the 20. We're still quite a long way above the 50, but that's really a nice little target. One thing which is different is that the NASDAQ has closed below the 10 and the 20, and we're sitting more or less on the 50. We've closed just below it. So you can see for yourself how we've just as soon as we've got the bullish crossover here in March, it looks as though towards the end of April, if not early May, we're going to see the subsequent bearish cross, which is just going to annoy a lot of people who are trying to jump into a trend following system where simply the market's not trending. We're simply moving sideways, and you should be seeing that for yourselves. There are a few points which I want to point out. If you've sat through this long, that's great. I've made this analysis both publicly on YouTube before, and also in more detailed response in that pro analysis class, which I do over the weekend. But this is really the line in the sand for me. So as you are all well aware, I haven't shied away from my bearish bias, even throughout this most recent little counter trend run up to the upside. I've accumulated shorts since this point over here, since November 2015, or really since the breakdown in August, but most specifically over here in November, and again over here at the breakdown at 17,126. I've added to some shorts on the bullish move up, and for the past 2 or 3 weeks, I haven't actually added. I'm also just sitting and watching this market, just thinking about the opportunity for a long-term hedge if this analysis plays out. So what I'm going to do for you is just show you more so where the line in the sand is for me in terms of analysis, right? And what is really going to tell us that this market is in the process of rolling, if not about to usher in a significant pullback, a retracement, a correction, whatever it is you want to call it, or if not, go out and say that, look, we're moving into a bear market. And it really coincides with the 10 and the 20 on the monthly chart. This is simple moving averages, but we're looking at the charts on a monthly time frame, or at least a monthly candlestick chart right here. What we've seen since the turn of the millennium, really, again, just to break this down, it doesn't matter which market I show you, but when we get the 10 crossing the 20 and price below both, we enter into a bear market. When we get the 10 above the 20 and price above both, we enter into a bull market. That is held true, at least since, again, the turn of the millennium. You can see over here, again, that the 10 crosses the 20, price falls below both, we enter a bear market. Ultimately, the 10 crosses the 20, price above, we enter a bull market. It's the same for all of these markets. This is taking into consideration the 2000 top and, of course, the most recent, financial crisis or bear market that we moved into at the height of 2007 down to the lows in early 2009. But you see the cross, price below both, in a bearish alignment, bear market above, bullish, bull market, and then again a subsequent bear market. And then again, subsequent bull market. This has led us all the way back up into the heights of at least the 2015 high in May or June, depending on whether you're looking at the Dow, the S&P, or the NASDAQ. NASDAQ was the last to top. Coincidentally, right now, or ironically, it's the weakest of the three markets and looking to roll first of the three. But if you take into consideration most recently, we've actually got that bona fide cross. That happened at the beginning of 2016. And obviously on this most recent bullish run-up, we've seen markets look relatively bullish. I'm under the assumption still that this is a false and flaky move. Now, the Dow has made the cross, as you can see. However, price is above the 10 and the 20. If you pay attention to the S&P 500, what has happened, we've made the cross, but we are just holding above the 10 and the 20. So for me to really pull the trigger on this market, and I'm going to speak about the NASDAQ because right now we've made a significant bearish move on the NASDAQ, which I'm going to highlight more. But if I just quickly bring up the annotations, hopefully they come back up on my screen. You may be asking yourself, well, what's this purple trigger on your screen? Again, this is simply the monthly chart with the 10 and the 20. But this is really the trigger for me long term to really open up or at least add to my already quite large existing short position right now. For me to start adding to additional shorts, I'm looking at the Dow Jones to pull back below 17,100. That's going to align with price, or at least the 10 below the 20 and price below both. All right. And, statistically, in terms of technical analysis, this will work. So really the line in the sand, here we are, we're closing at 17.8. We have about 600 or so points, 630 points until we get to around that 17.1 figure. And if price fails to hold that, that is where I will be initiating my shorts. Again, on the S&P 500, you can see this strategic little purple trigger right here. It isn't really a trigger. It's just an alert for me to visualize the actual price action. It doesn't mean that it has to happen, but I'm just sharing my open analysis with you as to why I'll be acting at this point or at this level and what I'll be doing at it. Again, I'll be taking on longer term short positions as some form of a bearish hedge for this market if in fact it turns into a bear market. Obviously today, just to update you, GDP growth again was anemic. It came in at more or less half of a percent. That is the Q1 estimate, the first estimate for the first quarter of 2016. There's a good chance in a month's time that this figure of 0.5 will actually be revised lower. So, I mean, we are really flirting on contraction, if not just, again, continued anemic growth. I think it was the worst print since 2013. And again, estimates were looking up closer to 1%. So, I mean, a lot of revised estimates, or at least estimates, are being revised lower. So, I mean, this is really sitting with contraction or very close to contraction. But just pay attention to the revised estimate, the second revision, which will be announced next week. And then, of course, the final print, I think, comes out in June for the final print of Q1. So, I mean, that's just something to think about also. But really, 2017 is my entry on the S&P 500. You can see if I zoom out, this is the monthly chart. We are still setting up a series of macro lower highs and lower lows. And there's a few things I'll quickly speak about on the weekly chart. But before I get there, let me just speak about the NASDAQ, because the NASDAQ is something I've spoken about over the past few weeks. I'm not sure which YouTube update I referenced this, but at the point, we had a very similar candlestick to what we have now. A couple of weeks ago, this was looking like a bullish continuation. At some point, this was a long white candlestick, but I was saying, look, if we see rejection up at these highs at the gap fill and we start to see a shooting star candlestick, this is on YouTube at some point. It's obviously throughout the month of April, because it was during the formation of this candlestick. Well, then that really ticks the boxes of a failed gap fill, right? Because if I go to the weekly chart, which I'm going to do in a couple of seconds, you're going to see why this is. But this is a shooting star candlestick at the resistance box. This is where the opening gap was in 2016, and price is now pushed below the 10 and the 20. Now, the 10 hasn't crossed the 20, but this is just another bearish signal, which I'm updating you on as at the close, as at this Thursday. So think about that as well. On the NASDAQ, the Dow Jones and S&P have got the bearish cross, but price at the moment is again fluctuating above. I assume that this is going to fail. It's only a matter of time. How long these markets can tread water up and around these all-time highs with, again, contraction in earnings per share. It's very interesting to note the formation and the continuation of these signals. But looking at this, when I go into the weekly chart, just pay attention to this on the NASDAQ. It just becomes so apparent. I'm zooming out. Actually, I might just take this off my screen and just go to the weekly chart. You can see this for yourself. Ask yourself the question, are we making higher highs or lower highs? And you can see this open window right here on the weekly chart. It has been in many instances, a magnet which we are trying to close. We've come back up, got very close to it. We still haven't done it. So that's why I'm under the assumption we get a legitimate pullback down to about maybe 4.5, and then we see one final rally back up, close the gap at 5,000. That would be the end of the exhaustion, or at least the end of the most recent bullish rally. It doesn't have to happen that way, right? So don't think that it has to happen this way. This is just my, I guess, speculation on how it's all going to play out. There's a very good chance that if we see a legitimate rejection at these levels, that these markets just pull back all the way down to about, or at least their relative 2016 lows, without seeing that secondary push back on up higher. But at best, I think we're going to see a relative high, which is going to enable the structure ultimately for this this bearish wave to sort of, flow back in, or at least the selling pressure to flow back into the market. So, man, that is really my update technically on these markets. Just stay safe out there. I know it's painful to find yourself waiting a lot. It may become a little frustrating. I understand that. But unfortunately, we cannot press the fast forward button in real time. We just have to simply sit through it, stick to our analysis, let our analysis guide us, and not to be someone, or at least a technical trader, or even a long-term value investor, buying this market up at these levels. Because again, historically, we are the third most overpriced market since the 1880s. And as at today, ironically, we have moved into the third longest bull market, all right, on history, on a day where we saw the markets really pull back at critical areas of resistance. And again, adhering to our long-term macro view of where this market is moving. So we are coming towards the end of what is, in my opinion, been, again, the third longest bull market in history. We are, I think, what did I just say? Equal second most overbought. No, actually equal third, pardon me, outside of the roaring 20s and the dot-com bubble. We've now eclipsed more or less 07, 08 valuations. And we're looking at some regressions, or at least mean revisions, where price is obviously going to have to revert back to the mean at some point. Technically speaking, we haven't seen a more appropriate time than what we've seen in terms of the technical picture setup since 2014. At best, what we're going to see in this market, if this turns out to be a long-term consolidation and ultimately a bullish breakout, which is not what I'm expecting, is that we're going to look back in history and say, well, this is a long-term sort of consolidational phase. However, much like I spoke about over the weekend, instead of calling this a consolidational phase, which is really just a sideways market move during a bullish trend, which will ultimately break out and continue the long-term bullish trend, to me, this looks like perfect, more or less, distribution. Now, distribution establishes itself. That is horrible writing. I'm trying to use my mouse at the moment. It's meant to say distribution. But as you can see, distribution, it takes place in the form of really the top of bull markets. And it's really the smart, or at least the institutional investors, distributing their positions to the retail investors who are buying at the absolutely worst time. So if I zoom out, maybe it's best to show you this on a weekly chart. Distribution takes place at the top. So when you get to the top of a bull market, let me just try and color coordinate this. So you're during let me bring up the green key. There we go. Bull market up into the top. Distribution takes place. This is where people are selling, or at least institutions, and at least informed participants, I should say, are selling to the retail investors before we enter into a correction. What happens? We get into a phase, or when the news is most bearish down the bottom of a bear market, that's where, again, the informed investors are accumulating their positions. Then we see the public participation, which drives bull markets. We get to the top and we see a distributional type of phase. It's hard to understand, or at least to sort of forecast how long a distribution is going to take place. But really what you should be able to analyze is really the difference between accumulation, consolidation, and distribution, and what really drives bull and bear markets. It's always the public. It's the public participation, right? Oftentimes, obviously it's bullish, right, which is sort of shown by my screen in green. But when you get to tops and you see these wild fluctuations in price, and you start to see the establishment of macro lower highs and lower lows, and all the warning signals in terms of divergences, not only on the daily charts, but on the weekly charts and the monthly charts, well, then you really need to, again, just be honest with yourself and say, look, this looks to be a major divergence and also distributional phase, which is ultimately going to end in, problems for people who are buying the market. One thing which I haven't spoken about is you see these crosses on the daily charts in the divergence, which I've referenced. If you pay attention to the weekly chart, and also I've been speaking about this occasionally on these public updates, but also more so in the pro format, we're about to get the cross. If you have a look at the stochastics, this is the Dow Jones Industrial Average. You see we're about to get the cross on the Stokes, or at least we've moved back up into overbought. The RSI is already turned down. Don't pay attention to the MACD. MACD is lagging, especially on the weekly chart. You want to pay attention to the MACD on the monthly chart, and then also on the daily chart. But if you have a look at it on the S&P 500 also, I mean, the signal line is, or at least the fast line is starting to plateau. It's about to cross. And this is a major problem for the bulls, because when you get these crosses on the weekly charts, bad things happen. And on top of that, I'll quickly show you it on the NASDAQ. The NASDAQ is very close, very similar to the other picture. But when you align this with the, let me bring it up, the monthly chart, it's going to align with the macro sell signals we're seeing on the stochastics, the divergence, and also the bear market we're seeing on the RSI. And the MACD as well, which has given us, or at least signaled across it at the 2015 highs. When you get the monthly in alignment with the weekly, and then that will align with the daily, right? So if I go back to the daily and show you this as well, this has been a longer market update, but hey, I hope people have learned something throughout it. When you start to see all of these time frames in agreement, that is very, very problematic for people who are sitting on the opposite end of where the momentum and where the crosses are taking place. So these are all bearish crosses. So for the bulls out there and people holding long positions, people who've unfortunately bought into this bullish move, this is where it starts to become painful. Now, it may not happen overnight. It may not happen next week. It may need another month or so to take place, but these are macro sell signals converging, or at least aligning with daily sell signals, and there'll come a breaking point. Now, what was good to note is that more or less the bears, or a lot of the bears, had thrown in the towel up here, and that's great, because when one side of the trade capitulates, that's generally where the reversal takes place. So much like a reversal which happens during the end of a bear market, it's where the bulls actually just give up, is where a market low is actually, or where a market low more or less establishes itself. Much like these critical reversals which we're expecting to show up when bears are stretched to their limits and more or less they've given up and things are just looking that bullish, that's generally where you see the critical points set up. And that's what we've really seen materialize over the past 2 weeks. We have that inside day spinning top on the NASDAQ, and then a bearish continuation to the downside. On the Dow Jones Industrial Average, we have that shooting star candlestick followed by one black crow as at the close on Thursday. In the S&P 500, another shooting star up at that declining reversal or declining bearish trend line. And then we're starting to see the tweezer top once again establish itself, much like we saw a couple of weeks ago over here. But again, on top of that, what is very interesting to note, to look at this on some form of a macro level, but to really zone in on that macro level, what's very, very interesting to note, and this is something again which I spoke about a number of weeks ago, and it's playing out perfectly right now. Just go back and have a look at one of the videos I did in April. It referenced this very same formation in the candlestick, but it's very, very interesting to note is that look at this shooting star candlestick on the monthly chart on the NASDAQ. Very, very problematic. If that gets across, then we'll have more or less all three markets in agreement, and then we'll just be waiting for price of the three markets to crack below those critical levels, which I've shown you. And again, you can see where they're aligned on the daily chart. And this is how I'm going to finish this week's, or not this week's video, but at least this market update, is that these purple lines for me, and I'm only speaking on behalf of myself, it makes sense to think about hedges. Now, again, I'm not telling anyone what to do on this market. This is my own analysis, which I'm sharing with people, but these are the critical levels which I am paying attention to. At these points, I expect the market to take a hard negative immediate outlook. It's not as though the NASDAQ, say for instance, tomorrow, it moves below 4778 and, don't go ballistic on shorts. It's not like that. It's a gauge where I want to see all three markets close below. Most importantly, the Dow and the S&P 500, because as you can see, we're still a long way away from it. It's coming in at about 17.1. We're all the way up here at 17.8. All right. And on the S&P 500 again, it's coming in at about 2017. We're all the way up at 17,000. Oh, sorry, 2017. We're all the way up at 2075. All right. So these are just big macro sell signals where I guess the weight of the evidence is really going to turn hard negative. And you'll probably see again, more or less short-term capitulation. Unfortunately, this time when we rotate all the way back down to 15.5, I don't expect support to hold for that long. And then when you look at the markets like this, and this is where it gets really scary, because all of this in a way is just sort of the pre-play to the main event. Unfortunately, when you get to tipping points, is that you can clearly see support here, right? You see this macro support, which has established itself on the Dow Jones Industrial Average. It's coming in at about 15,750. We'll have a look at the macro support, which developed over here, right? 2007, 2008, this was all sort of volatility moving back and forth, the establishment of the lower highs and lower lows. Ask yourself the question, what happens once this macro support is broken? That is where you see capitulation. And it just repeats itself over and over and over again. Macro support, we more or less move sideways for a year. What happens when we break it? It ushers in capitulation. Fast forward to 2015, 2016, have a look at the S&P 500. Look at that perfect macro support. I can give you the triggers, 1,870. If that level more or less breaks, it's really coming in at 1,785. That is where you see, expect to see capitulation. And it's very simple to say, look, where's the macro target on the S&P? Well, it's coming back to the 2000 top and also the 2007 top, which is pricing this market in at about 1,500, right? So if you look at where we are now at 2,075 and you've got a target, a very legitimate price target at 1,500, given, of course, that macro support breaks and we are still a couple hundred points away from it, well, then you can really start calculating some risk and reward calculations, or at least going through some risk and reward calculations and saying to yourself, well, theoretically, if I was to take a short at 2,075, where would my stop go? It would come up all the way here at about maybe 2,120. Say, yeah, that's about 50 points of risk. What's my downside target? It's about 575 points. Sorry, that's the wrong number. 575 points with, say, risk of 500. I mean, you do the maths on that. That's over a 10-to-1 risk-reward ratio. And they're the types of probabilities that you want to be trading as a technical trader. You don't want to be trying to, throw the Hail Mary, taking long positions at in retrospect, which is probably going to be the absolute worst time to be buying a market. You'd rather just understand the market for what it is, understand that, it takes time for these things to set up in terms of a reversal. We're starting to see it. And, 10-to-1 on a trade, or at least analysis with as much conviction as what I've just walked through with you over the last maybe 15, 20, I don't know how long I've been speaking for, but that's what you should be thinking about. Again, my entries are a little bit lower just because I want to see these macro signals play out. And if that's the case, I mean, you're still getting a 10-to-1 risk and reward ratio. Actually, it's not going to be 10-to-1 because your risk is going to be a little bit higher, but it's still going to present you with, over 500 points to the downside once these lows crack over here. But I'll update you obviously as the chart continues. Interested for Friday's trading session, but again, a lot of earnings have been quite weak. I think on average, the most recent estimates of what the actual Q1 earnings are going to be quarter over quarter is they're looking at negative 8%. I was reading estimates that they were going to be closer to 11% contraction, but it's now looking as though it's going to be about 8% with the Facebook, that's meant to say Facebook, not an E, Facebook and Amazon earnings, which have beaten estimates. But, counter to that, just see what Apple's done, have a look at what Google's done, have a look at what Netflix has done. These are all stocks which have gapped to the downside. And again, it's across the board as well, IBM. The financials are going to come under a lot of pressure as well in due course. Not so much now, but pay attention to the financials as well. But outside of that, I think I've spoken about everything I wanted to. I'm going to finish this video now and update it, or sorry, not update it, render it and post it to YouTube. If you have any questions, email me success@pivotpoint-trading.com. And also, I'd encourage you to have a look at Pro if you're interested in market analysis and other sort of technical reasons as to why we're so hesitant on this market and why potentially we may be looking at, a macro topping picture where we may not come back or at least revisit these levels for another 10 to 15 years, much like we saw in the year 2000, right? We didn't get back up to these levels until the year 2015. So outside of that, traders and friends, market enthusiasts around the world, have a fantastic Thursday evening. I'll see you over the weekend in that pro analysis class. All the best, everyone. Goodbye on behalf of James.